Did you know that if all the homeowners in the United States were to line up their homes side by side, they would wrap around the earth not once, not twice, but 3 times? That's right. The combined value of residential real estate in the US is staggering, reaching into the trillions. Now imagine being able to tap into this massive wealth pool through smart mortgage management. Whether you're paying down your mortgage or using leverage to acquire more properties, the choices you make could significantly impact your share of this enormous pie. Finance first, freedom follows. Welcome back to FinC Freedom. In today's episode, we're delving deep into the world of real estate to unravel a question that puzzles many homeowners and investors. Should you pay off your mortgage early or use that extra cash to leverage more property investments? This decision can significantly impact your financial landscape, and today, we're going to explore just how much. Paying off your mortgage might seem like the safer bet. It cuts down your debt and boosts your cash flow. Plus, there's undeniable peace of mind in owning your property outright. No more monthly payments, just pure profit from your investment. But then there's leveraging, using your capital to snap up more properties and expand your portfolio. This can mean more income through rentals and greater gains from property appreciation. Yes, it's riskier, but the potential rewards are bigger. So, which path should you take? With over 64% of Americans own their home, it's a good question for so many of us. Stick around as we break down the pros and cons, helping you make an informed choice based on your financial goals and market conditions. Benefits of paying off mortgages. Let's dive into why paying off your mortgage might just be the best decision you can make for your financial health. First up, security and reduced risk. Owning your home outright means you're not at the mercy of fluctuating market conditions that can increase mortgage rates or impact your ability to pay. It's a safeguard, a buffer against economic downturns. Consider this. A study by the Federal Reserve found that homeowners with no mortgage payments are less likely to default, leading to a more stable financial situation during crises. It's not just about saving money, it's about securing your future. Next, increased cash flow. Without a monthly mortgage draining your bank account, your disposable income shoots up. This isn't pocket change. For the average American, mortgage payments can be their biggest monthly expense. Statistics show that the average monthly mortgage payment is about $1 in $500. That's $18,000 a year back in your pocket when you're mortgage-free. Imagine what you could do with that extra money. More savings, more spending, more financial freedom. And let's not forget the emotional piece. There's a profound sense of achievement and stability in knowing your home is fully yours. No more mortgage worries hanging over your head. It's not just a financial win, it's an emotional relief too. So, is paying off your mortgage early worth it? For many, the answer is a resounding yes. The peace of mind, increased financial stability, and freed up cash flow are benefits that can reshape your financial landscape. 2. Advantages of buying more with leverage. Now, let's explore the flip side. Using leverage to grow your real estate portfolio. It's about making your money work harder for you. Leverage allows you to purchase more properties than you could if you were just using cash. This is the power of growth and scalability at work. Leverage on cash flow rental properties are good debt, according to Robert Kiyosaki, the author of Rich Dad, Poor Dad. Think about it. With a 20% down payment, your $100,000 could turn into a $500,000 investment. That's 5 times the potential return on the same dollar amount. Here's where it gets interesting. The average rental yield in major U.S. cities ranges from 3% to 8%. So, leveraging to acquire more properties may significantly increase your total income. And don't overlook the tax benefits. The interest you pay on your mortgages? It's tax deductible. This can reduce your taxable income and save you thousands each year. According to IRS data, real estate investors saved over $15 billion last year through mortgage interest deductions alone. That's a massive financial advantage. But what about the risks? Yes, leveraging increases your exposure to market volatility. More debt means higher financial obligations. Yet, when property values increase, the payoff can be substantial. Let's say property values rise by just 3% annually. On a leveraged $500,000 property, that's a $15,000 increase in value each year, compounding over time. Compounding growth is where leverage truly shines. Over 10 years, that same 3% annual appreciation turns your $500,000 property into one worth nearly $675,000. And that's on top of the rental income. Managing more properties does bring more responsibilities. It means dealing with more tenants, more maintenance issues, and potentially more headaches. But here's the thing. Effective property management and a solid investment strategy can mitigate these challenges. Many successful investors hire property managers to handle the day-to-day, allowing them to focus on the bigger financial picture. So, is leveraging to buy more properties worth it? For those who do their homework and manage their investments wisely, leveraging can amplify returns significantly. Both paying off your mortgage and using leverage have their benefits. The key is to choose the strategy that aligns with your financial goals and risk tolerance. Remember, in real estate investment, knowledge is not just power, it's profit. 3. Consideration and risks. Leveraging can be a powerful tool, but it's not without its risks. Let's delve into the key considerations every investor should weigh before deciding to leverage their real estate investments. First, consider the market's nature. Real estate isn't just about buying low and selling high. It's affected by economic cycles. During a downturn, property values can plummet, and so can rental incomes. Historically, markets recover, but the real question is, can you withstand the storm? According to a real estate industry report, property values during the 2008 financial crisis dropped by an average of 33%. For those heavily leveraged, this was devastating. Stability takes time. Real estate is a long game. You need enough financial cushion to hold onto your properties during tough times. This means having substantial reserves. Experts recommend having at least 6 months' worth of expenses saved up as a buffer. Without this, you're at a higher risk of foreclosure if your cash flow turns negative. Interest rates are another critical factor. They directly affect your monthly payments. Higher rates mean higher costs, diminishing your profit margins. Let's break it down with a simple example. If mortgage rates increase from 4% to 6% on a loan of $500,000, that's an extra $10,000 per year out of your pocket. Over a 30-year mortgage, that's $300,000 more in interest payments alone. Now let's talk about management overhead. More properties mean more tenants, more maintenance issues, and more of your time. A survey by a national property management firm found that 52% of landlords say maintenance is their biggest challenge. And each property added to your portfolio amplifies these challenges. It's not just about finding tenants, it's about keeping them happy, maintaining the property, and ensuring everything runs smoothly. But it's not all doom and gloom. With careful planning and robust management strategies, these risks can be mitigated. Many successful investors outsource property management. This can be a game changer, allowing you to focus on expanding your portfolio rather than getting bogged down in daily operations. So, before you decide to leverage, make sure you're prepared. Understand the market, secure your financial buffers, keep an eye on interest rates, and have a solid management plan in place. Remember, in real estate, being well-informed and cautious is just as important as being ambitious. 4. The 9-9-95% rule, or 10% rule. Let's delve into a crucial rule that every savvy real estate investor should know. The 9-9-95% rule, or the 10% rule. Understanding this can help you decide when to buy properties with cash versus when to leverage. The rule is simple. It states that if mortgage rates rise above 9.95%, it's generally better to purchase rental properties with cash rather than using leverage. If rates are lower, leveraging could lead to greater financial benefits. But why this specific number? Let's break it down with real data and calculations. Assume you have two options. Buy a $1 million property with all cash or leverage to acquire a $5 million portfolio with a 20% down payment. The rental yield is consistent at 5%, and properties appreciate at 3% annually. With the cash purchase, your investment is straightforward. You earn 5% rental yield plus 3% appreciation on your $1 million investment. That's $80,000 annually, compounding over time. On the leveraged side, the numbers are larger, but so are the costs. The rental yield on a $5 million investment provides $250,000 a year. However, you must deduct interest payments. At an interest rate below 9.95%, your annual interest on a $4 million loan, 80% of the property value, is less than the income and appreciation combined. But if the rate exceeds 9.95%, interest payments start eating significantly into your profits, potentially turning net gains into net losses. For instance, at a 10% interest rate, you'd pay $400,000 annually on the loan. Even with $250,000 from rentals and $150,000 from appreciation, totaling $400,000, you're just breaking even before any other expenses. This illustrates why the 9.95% threshold is crucial. It's the tipping point where the cost of borrowing negates the benefits of additional income and appreciation from leveraging. But let's not forget about reinvestment. Any rent collected can be reinvested at an assumed rate of 5%. This reinvestment adds another layer of complexity to our calculations. Reinvesting your rental income at 5% adds compounding growth to your wealth. Over 30 years, this can significantly amplify the total returns of your portfolio, regardless of the initial investment strategy. However, the ability to sustain this growth depends on keeping interest costs in check. Our rule helps investors navigate these waters when deciding how to structure their real estate investments. Remember, the real estate market is dynamic. Rates change, markets fluctuate, and strategies must adapt. The 99.95% rule gives you a benchmark, a starting point for making these critical decisions. The assumptions we base this rule on, such as rental yields, property appreciation rates, and reinvestment rates, can all change. And with each shift, the threshold for this rule adjusts as well. For instance, if the annual property appreciation rate increases, the tolerance for a higher mortgage interest rate also rises. This means you can afford to take on slightly more expensive debt because the increased growth in property value compensates for the higher borrowing costs. This delicate balance is the hidden rule behind leveraging. Whatever leverage you add, ensure it doesn't lead to financial ruin. The goal is to enhance your gains without stretching your financial safety net too thin. This approach prevents the risk of going bust, a situation where your debt obligations overwhelm your investment's capacity to generate returns. But as always, it's essential to analyze your specific situation. Look at your financial stability, market conditions, and long-term goals. Real estate investing is not just about following rules, it's about making informed decisions that align with your personal and financial objectives. So whether you're paying in cash or leveraging, make sure your decisions are backed by thorough research and solid calculations. Your real estate journey depends on it. Today, we've journeyed through the intricate world of real estate investment, exploring the strategic decision-making involved in managing mortgages and leveraging properties. Whether you choose to pay off your mortgage or use leverage to expand your portfolio, the key is to understand and balance the risks and rewards. Paying off your mortgage brings undeniable security, increased cash flow, and emotional peace. It's a safe harbor in the unpredictable seas of the real estate market. On the other hand, leveraging can significantly enhance your portfolio's growth potential, offering higher returns through strategic investments and tax advantages. But remember, with great potential comes great responsibility. Leveraging increases your exposure to market fluctuations and financial strain. It demands vigilance, sound management, and a solid understanding of the market. The 99.95% rule serves as a guide to help you navigate these decisions. It's a tool, not a rule book, tailored to assist you in evaluating when to invest with cash or credit based on the prevailing mortgage rates. As we wrap up, I encourage you to reflect on your financial goals, assess your risk tolerance, and consider your long-term objectives. Real estate investment is not just about the properties you acquire, but the life you're building with those investments. Keep working towards your financial goals and be kind to the other. Drop your questions or experiences in the comments below. Let's keep the conversation going. Thanks for watching and see you in our next video.